Hi, welcome to Lecture 4, covering Chapter 4 of Focus on Personal Finance. Today, our chapter is going to cover financial services, savings plan, and payment accounts. Today, we really live in a different and rapidly changing environment for financial services. We now have many online banking options that were not available even just a few years ago. And we face tougher account requirements, and our accounts are paying us lower interest earnings while we're paying higher fees and higher interest rates on loans. The requirement to purchase a house are harder. We just went through that, and I can attest to that fact. And we have more options for banking available to us, a lot in part to what the internet is offering. We need help navigating the financial services available and understanding which ones support our financial goals, and that's what Chapter 4 is all about. It's chock full of tidbits of information that will be helpful to you as you navigate your financial journey. So let's get started. Using your savings plans, your payment accounts, and other financial services is a primary personal financial planning activity. And this chapter, Chapter 4, starts with an overview of these services, followed by a discussion of our changing environment, how financial services are changing, which is caused in part by technology and other by economic conditions that we currently are experiencing. And next, we're going to discuss the different types of financial institutions that are available to us, along with factors to consider when we select one. Coverage of choosing and using savings plans include material on the types of accounts that are available to us, and then we'll conclude by talking about the selection and use of different types of payment methods. So let's get started. Let's begin by looking at our objectives. So objective number 1, identify commonly used financial services. So financial products such as savings plans, your checking account, loans that you'll take out through various companies, trust services, electronic banking, these are all used to manage your financial, daily financial activities. Our objective number 2 is to compare the types of financial institutions that you'll be choosing. These include things like your commercial banks, savings and loan associations, mutual savings, credit union, life insurance companies, investment companies, finance companies, mortgage companies, pawn shops. We want to look at all of these different types and look to see what it is that they offer, pros and cons. Objective number 3, we want to assess various types of savings plans. So commonly used savings plans include just a regular savings account, CDs or a certificate of deposit, interest earning checking accounts, which is always nice when we can get those, money market accounts, and U.S. savings bonds. We're going to look at each one of these. Savings plans need to be evaluated on the basis of your rate of return. What are you getting for allowing them to use your money? Inflation, whether or not there's any tax considerations, liquidity, how quickly can you get to those funds, how safe are they, what are the restrictions, and what are the fees. And then objective number 4, we're going to evaluate different types of payment methods and look at some of the pros and cons of these, like what's the debit card and how does that differ from a credit card? What are the online payment systems? What's the stored value card? We'll also look at and compare the different types of checking accounts, your activity accounts, interest earning checking, those types of things, as well as looking at fees and charges, interests, and special services that are attached to those. So let's get started. Let's begin by looking at our first objective. So, learning objective number 1 is identifying commonly used financial services. So, your daily buying activities require the use of financial services that facilitate business transactions as well as lead to the achievements of your own personal goals that you've set for yourself. In our daily buying activities, we use cash, checks, credit cards, and cash machines. These are the most common choices. Let's look at some of the common mistakes that are made First is overspending. A big one is impulse buying, buying things that you hadn't planned to buy. This happens a lot when you're running at the mall or the grocery store. There are things there that you hadn't planned on buying, but they're there and you decide on impulse that you want it, so you grab it, oftentimes using credit to pay for it. And this can be a common mistake in managing our finances. The second one is insufficient liquid assets. So you may have the assets, but they may be tied up in other types of investments, and you need to make sure that you have liquid assets available to pay for whatever it is that you are purchasing, especially if you're putting it on credit or credit card. Using savings or borrowing to pay for current expenses. So at the end of the month, you run out of money before you run out of bills, and so you have to borrow or to take money out of savings in order to be able to pay all of your monthly bills. And that is taking you in the opposite direction from where you want to be going, because we want to be saving money so that we can meet the financial goals and do the things that we want to do that we've planned for in our financial plan. And the final one is failing to put unneeded funds into an interest-bearing savings account or an investment account. My husband and I have learned that if we do not take the money out of our checking account and put it into the savings account on payday, it stays in there and we see it in there, and then the next thing we're thinking, hey, let's just go ahead and purchase this item which we hadn't planned to do. And if we had moved the money to savings to meet our bigger goals, our long-term goals, the goals that we had already agreed on, the money wouldn't be there and we wouldn't be purchasing things that we hadn't planned to purchase. The book advises against, and I would also personally agree with this, that it's not a good idea to put funds someplace where they're not working for you. You need to put your savings someplace where you're earning interest, or some type of an investment account. I actually spoke to someone who's a professional just this weekend, and she got worried because of what was happening in the market, and so she just pulled all of her money out a year ago and she just stuck it into a checking account, and she has a large sum of money sitting in a checking account, and it's not earning her any interest. She's not getting that money to work for her by compounding, by earning interest. And I was floored that an educated person would leave a large amount of money sitting into an account that's not working for them. This is a huge mistake, because you want to always be moving toward your financial goals and you want your money working for you. But there's always that but, right? But no matter how carefully you manage your money, there will be times that you will need more cash than you currently have available. So you've got to figure out how to cope with this. The way to do that are basically through either liquidating, savings, or borrowing. And though there will be times when this happens, I highly recommend that you quickly put together a plan so that you are not continuing to have to either borrow or liquidate month after month, to make sure you can meet all of your expenses, and that you also work towards putting together a plan to replace the money that you had to take out if that is any way possible. I do know that there are times when medical expenses and such come up that are unplanned for, and then it's wonderful that you have the money available in your savings or other ways to be able to cover your expenses. Look at some of the different types of financial services. They can be viewed in 4 main categories, which are savings, payment services, borrowing, and then just other financial services, a broader category. So your savings involves safe storage of funds for the future. Often think of savings accounts or CD, certificates of deposits. Payment services get you the ability to transfer money to others for conducting services, such as what happens in a checking account. You write a check to someone else to pay them for services, or you have an automatic payment that comes straight out of your checking account. Then there's borrowing for both short-term and long-term needs, and then other financial services, which would be things like your real estate purchases, tax assistance, trusts, financial planning, insurance, and those types of investments. Let me just touch on trusts very quickly, because I think that's the first time that term has come up in our lectures. So a trust is a legal agreement that provides for the management and control of assets by one party for the benefit of another party. So my husband and I set up a trust so that if anything would happen to us, then we would be able to transfer funds to our children. That trust will be managed by a trustee who would then make sure that the funds that we left for our children would be distributed to them according to our wishes. Type of financial service that I want to talk about is asset management account. Sometimes this is called a cash management account, and it provides a complete financial service program for a fee. So let's move on now to online banking. I was actually working in the banking industry when online banking started to really become popular. And we referred to banks, traditional banks, as brick and mortar banks. And then, so maybe you've heard that term before. And then online banking made its debut, and because of all of our connection to our electronic devices, it has taken off. So online banking through wireless mobile systems continues to expand daily. Some brick and mortar banks offer online banking, but then web-only banks are becoming strong competitors in today's market. So whether you are using a traditional bricks and mortar bank or a web-only bank, the services that you can get through your bank are direct deposit, and a lot of employers anymore are requiring employees to have direct deposit, meaning that your paycheck is put directly into your checking account for you, and then you just get a stub saying how much was put in there. Automatic payments, reoccurring payments such as utilities, and I mentioned my husband and I just purchased our home, and our house payment automatically comes out. I don't even ever touch that. Automatically transfer those funds, as well as our homeowner association dues, they automatically come out. An ATM, and it's automatic teller machine. Of course, you can use those during hours that banks are not regularly open. You can get cash, check your balance, and transfer funds, but be sure and check out fees, especially if you're using an ATM machine that doesn't belong to your bank, because more than likely you're paying fees to use that machine. So always look for either the name of your bank or the name of your banking association so that you can make sure you're not paying fees on your ATM transactions. And then your debit card, which allows you to automatically deduct money directly from your checking account. You use it like a credit card, but it comes out like a check. Make sure you know what your bank's debit card liability is if your card is lost or stolen. You need to know how much you could be responsible for, because those do vary sometimes from what a traditional credit card fees are. Normally, if you report a credit card that has been lost or stolen, they will and if you do it within 24, I think it's 6, I can't remember how many hours, I think it's later in our lecture, like within the first 3 days, normally you're not responsible for any of those charges that might have been placed against your account. It's not always true with a debit card, so make sure that you know what the policy is of your banking institution so you'll know what you're liable for if your card is lost or stolen. Move on from this slide, there's a couple other types of debit cards that I wanted to mention. There's a prepaid debit cards, and these are really becoming popular as a payment method. They're being used instead of traditional banking services. So a prepaid debit card is issued by a financial service provider, including retailers such as Walmart and non-bank companies, and they're created to provide a financial service, and you load them by adding funds to the prepaid card. You can load them through a cash, check, direct deposit, online transfer, smartphone check photo, or credit card cash advance. There may be a savings account feature that's also attached to the card. And the major concern with a prepaid debit card has been the extensive number of fees that a user can encounter due to a few current regulations, that there are few current regulations for this financial product. However, the upside of this is that it is showing that there is lower consumer debt, since the debit card helps to control spending. It's different in that with a credit card you pay later, and with a debit card you pay right now. But with a prepaid card, like what we're talking about, you actually pay before. So people have to preload the card before they can spend the money. And that is helping with people to be able to manage consumer debt. Once again, just watch for fees on those cards. Everything I wanted to point out from learning objective number 1. So let's move on to learning objective number 2. Compare the types of financial institutions. We've already talked a little bit about that, but let's dig in just a little bit deeper. The major factors to consider when selecting a financial institution are the services offered, how convenient is their location, how safe are they? Are they insured? Are the deposits insured? What are their interest rates? What are their fees and their charges? Will you be able to borrow money if you need it? What do they offer? Some of the different types of financial institutions that we need to look at. Well, traditionally, commercial banks have offered the widest range of financial services. And you've probably seen advertisements for savings and loans, and you wondered how they differ from a bank. Well, savings and loans traditionally specialize in savings accounts and then also in making loans for mortgages. A mutual savings bank is owned by its depositors, and it specializes also in savings and in home mortgages. And finally, let's look at credit unions. And if you're not familiar with credit unions, or if you qualify for membership at a credit union, I would highly encourage you to do a little bit more research and find out, because credit unions can be really great to work with for a lot of your financial services that you need. So credit unions are user-owned. They're nonprofit. They're cooperative financial institutions, and they usually offer a fairly wide range of services, just like a regular bank. So a nationwide survey of consumers consistently gives credit unions the highest satisfaction rating of all financial service providers. So I think that speaks pretty loudly. And I have to say that my husband and I have been big fans of credit unions through the years. We've used them for most, if not all, of our auto loans. We find that they're very competitive. They're easy to work with. We have used credit unions to get our kids set up and started on their own with their loans and with their checking accounts. You can have checking through a credit union as well. So what we have found is that they have lower fees and lower loan rates. And I would love to have used them for our mortgage as well. But oftentimes, as was the case with any time that we've purchased a home, the credit union where we have done business has not offered mortgage loans, or has not offered mortgage loans in the amount that we were seeking. Sometimes they want you to have 20% down, or they may have a limit on how much you can borrow. So at the times we've tried to use them, they've not met our needs, but they certainly had better interest rates if we would have qualified than the loans that we ended up having to take. So yes, big fan of credit unions. And then there are non-deposit financial institutions that I wanted to touch on as well, such as life insurance companies. Many life insurance companies offer policies that contain savings and investment features. Investment companies, sometimes referred to as mutual funds, have become involved in banking type activities. A common service of these are money market accounts, which is a combination savings and investment plan in which the investment company uses your money to purchase a variety of financial instruments. With these different investment companies, you do need to find out what type of insurance that they have on your deposits, and we'll talk about FDIC here in just a minute. But many of these investment companies are not insured through FDIC, and so you need to make sure that you are comfortable that your funds are secured should something happen to the company with which you're investing. A few more other types of non-deposit institutions is a brokerage firm, which employs investment advisors to sell stocks, bonds, and other investments. There are credit card companies that specialize in short-term loans, such as in retail lending. And then finance companies that make short-term and medium-term loans to customers at higher rates. And finally, mortgage companies that provide mortgages for your home. Though some of the non-deposit institutions that we just talked about certainly do require some investigation, there are a few problematic financial businesses that I do want to mention to you. The first is a pawn shop. I don't know if you've ever visited a pawn shop, but pawn shops make loans based on the value of some tangible possession. So if you need money, I hate to say say if a person needs money, they might take jewelry or a musical instrument or some other household item to the pawn shop, and the pawn shop will give them money on that possession, kind of like a short-term loan. I hold the possession, I'll give you the money. Then you come back and you buy this possession back from me at a higher fee than what I gave it to you for. So people sometimes use this for quick cash, but it ends up being a pretty high interest rate by the time that you purchase the item back. Check cashing outlets, and these stores or outlets will charge you a fee to cash a check. And consumers need to be wary because in some states an interest rate of as much as 25% is possible. So I would just highly advise you to stay away from pawn shops and check cashing outlets in totality. Before we leave this slide, I did have one more thing in my notes I wanted to share. About 17%, this surprised me, 17% of U.S. households do not have a bank account. And that's one reason why check cashing outlets do such good business. Because most financial institutions won't cash a check unless you have an account with them. So there are over 6,000 check cashing outlets, and they can charge you the face value between 1 and 20%. So you really need to do your homework to figure out what it is that it's costing you. That's just really incredibly high. I did have just a couple more problematic financial businesses that I wanted to visit with you for just a second about. And the next one is payday loan companies. They do advertisements all the time. You hear them saying cash advances, check advance loans. You can give me a post-dated check and I'll give you the money today. They charge higher interest rates. And if we thought the pawn shops and the check cashing outlets were high, our information in our book says that these payday loan companies can charge as much as 780% annually. 780%, that's just absolutely incredible. In a typical payday loan, a consumer writes a personal check for $115 to borrow $100 for 14 days, and then the payday lender agrees to hold the check until the next payday. So then the $15 finance charge is there for 14 days, which translates into an average of about 391% interest. Some consumers roll over their loans and pay another $15 on that loan for another 14 days, and that just continues to increase and increase and increase. So I'm going to take just a second and share a personal story about someone very close to me that, no, it wasn't me. It was actually one of my children who got caught up in one of these scams, and she needed some money, and rather than telling us that she was needing a small loan to get through for the month, she took out a loan, and it was so easy to take that out that she took out a second one like a week or two later, and then a third one, and the total amount of cash that she actually withdrew was $500. And by the time that we heard about what was going on, she was already in so much trouble. The fees and the interest kept hitting her. They had access directly to her checking account and knew what day she got paid, and so every time that she got paid, they would take out what they said she owed them. And literally within, it was like a 4 to 6 week period, we went from $500 that she'd gotten to $5,000. It cost us $5,000 to get this madness stopped and to get the loans paid out. and to get it stopped. So it's just absolutely incredible, and I can't advise you strongly enough, do not go to these payday loan companies or these advertisements that you see at night saying how easy it is to get money, and if you're running short, just call us and we'll give you this loan. And the interest rates are incredible. They're scams, and once they get their claws into you, they know everything about you, when you get paid, where you work, what you make, and they just continue to bleed you dry. And there's really not just a whole lot you can do. It's really kind of sad. So let's also talk for a second about rent-to-own centers. I know lots of people use them, and we see advertisements for them all the time. They offer things like, big screen TVs, 7-piece kitchen sets, kitchen appliances, computers, just about anything that you would want to rent. The rental purchase industry is defined as stores that lease products to consumers who can own the item if they complete a certain number of monthly or weekly payments. In Wisconsin, more than 10,000 customers of a rent-to-own chain became part of a class action lawsuit, and they accused the rental chain of illegally charging interest rates as high as 100% to rent these items. So you really need to be careful about the rental agreements that you enter into, and look at what you're really paying for that item by the time that you either give it back or you have purchased it and you get to keep it. And then you also have to look at what would it cost you if you had just purchased the item yourself. And then finally, car title loans. When in need of money, many people with poor credit ratings might obtain a cash advance using their automobile title as security for a high interest loan. And using these car title loan places, these loans are usually due in 30 days and typically have a cost similar to the loans we just talked about that I just warned you about, these payday loans, often exceeding over 200%. So really be careful when looking at these types of shady businesses and what other options are available to you if you have a need, because these high-risk financial services, they should just be avoided at all costs. All right, enough of that. Let's move forward with our learning objective number 3, comparing savings plans, because we'd much rather save than take out a loan at high interest rate, right? Yes. So creating sufficient savings really is foundational to good money management. So let's look at the different types of accounts. We have a regular savings account. Sometimes these are called passbook savings, and the reason that they were originally called passbook savings is because in the olden days, so when you open a savings account, they give you this little book, and whenever you would make a deposit, they would write inside the book how much money that you deposited and what your new balance was, and so they called them passbook savings accounts. A little bit of history for you there. These regular savings accounts or passbook accounts usually involve a low or no minimum balance, so they don't require you to keep a certain amount in there, and they allow you to withdraw money as needed, and there's not any limitations to how often you can do that. So if you would need to withdraw money a couple different times in a month, though I know that's not what we're trying to get you to do, but there are times when that might happen. There's nothing that prohibits you from being able to do that. These institutions are insured, and we will talk about insurance here in just a second. And if you have the same type of savings account that you have it at a credit union, they might call that a share account, and the reason for that is because credit unions are considered to be owned by all of its members, therefore that's how they got the name share account. So let's take a second and look at a certificate of a deposit, or a CD. So a CD is a savings plan that requires you to leave a certain amount on deposit for a set period of time, and that can be any place from 30 days to 5 years or 10 years or even more. And you have to leave it in there for that specified amount of time in order to be able to earn the specified interest rate that has been advertised. So there's a wide variety of CDs that are available, and each have their own unique characteristics, their own unique returns, and their own unique requirements. So the book on page 115 takes you through a list of CDs and spells out the specifics for each. So if you have interest in considering a certificate of deposit as a savings tool, I would encourage you to look over that list on page 115, or even just look over it so that you can familiarize yourself so that you might be able to make better investment choices whenever the time is right for you. So you expect to get interest on your savings accounts, but it would also be nice if you could get interest on your checking account. Some checking accounts do pay a lower interest rate than what you can get at with a savings account, but some interest is better than no interest. Credit unions in particular are good about paying interest out on checking accounts. So when looking at your options, be sure and make this one of the questions that you ask as to whether or not any money sitting into your checking account is earning you money while it's there. And I would caution you about allowing a large amount of money to accumulate in your checking account because the interest rate that's being paid out is so small. So to have the better savings tool, you want to move those funds periodically to a higher earning investment tool. All right, money market accounts. A money market account is a savings account that requires a minimum balance and bases its earning on the current market's interest rates. Therefore, it's neat. Money market accounts allow savers to write a limited number of checks to make large payments or transfers of money to other accounts, but you are limited to a certain amount of checks each month, so make sure that you know what those are, and then also make sure that those accounts are covered by FDIC insurance. Another savings vehicle are U.S. savings bonds. I know when my husband and I first got married, we were able to purchase quite a few Series EE savings bonds, and they actually worked out really nice for us so that we were able to put that money back, and then at a later point when they matured, we were able to cash those out for when we had our first baby. So I always have a warm spot in my heart for U.S. savings bonds. Savings bonds, U.S. savings bonds are a low-risk savings program. They're guaranteed by the federal government, and they can help you to achieve various financial goals. The Treasury Department offers various programs for buying savings bonds, and the most common being Series EE, and they may be purchased for any amount greater than $25. They can be purchased online at the face value. For example, a face value of $50 bond, you're going to pay $50 for the bond, and then they increase in value as interest accrues monthly and compounds semi-annually. And if you redeem the bond before 5 years, you forfeit the latest 3 months of interest. And if you wait till after 5 years, then there's no penalty. Normally, anything that you earn from investing in a Series EE bond would be subject to income tax unless you use those dollars to pay fees at college or university or technical school for either yourself or for a dependent, and then you can use those funds without having to pay taxes on them, which is always a nice benefit. Can you evaluate savings plans? Well, the answer to that is by looking at your rate of return or your yield. So your rate of return or your yield is the percent of interest in the value of your savings due to earned interest. Okay, I had a little blip there in my recording. I want to make sure that we're both on the same page. So let me just say that we're going to evaluate our savings plans by looking at our rate of return or our yield. And our rate of return or our yield is the percent of increase in the value of our savings due to earned interest. And the frequency of compounding is important. So let's just look at compounding for a second before we move forward with looking at the frequency of compounding. So compounding refers to interest that is earned on previously earned interest. the more frequent the compounding, the higher your rate of return will be. So there is actually an excellent chart in your book on page 121, and that helps teach the concept of compounding. So if you want to turn there, it's important to note that the shorter the compounding period, the higher the yield. So beyond knowing what interest rate that you're getting for your funds, you also need to know how often that interest is compounded, whether it's daily, monthly, quarterly, or annually. And the more frequent that it's compounded, the more desirable that is, because that means the more money that you're going to earn. And so this chart gives you an example of that. So if you look at this example, just following along quickly at the bottom, how much that you earned, if they only compound your investment annually, in this example, you're earning an average of 4% interest. Where if it's quarterly, it goes up to 4.5, and monthly 4.7, and then finally daily it's 4.08. So you want to be compounded more frequently rather than less frequently. And if you look at the example, even though the difference between 4.08% and 4% doesn't seem to make much difference, over a period of time it can make a difference, and the larger the sum of money, of course, the larger difference that makes. So you want to ask how often the interest is compounded, in addition to asking what interest rate that your money will be earning. In 1993, the Truth in Savings Act became effective, and this law requires financial institutions to disclose information on any savings plan that they offer in regard to any fees that they're going to charge on the deposit, what is the interest rate they'll be paying, what's the APY, or the actual annual percentage yield, and other terms and conditions of the savings plan. In evaluating your savings plans, be sure and consider current inflation. So the rate of return that you're earning on your savings should be compared with the current inflation rate. In general, as inflation rates increase, the interest rates offered to savers also increases. And this gives you an opportunity to select a savings option that will maximize the erosion of your dollar against inflation as you put your money on deposit so that it works for you. So just for a quick example, let's say that the current inflation rate is 2%, meaning that your money is eroding at that rate. You wouldn't want to tie up your dollars in a savings plan that is not giving you at least enough to offset inflation, especially if there are other options out there. There have been times, however, I have to say that inflation has been high and rate of returns that are being offered are low, and it's painful to have money sitting in a savings account knowing that it's actually drawing less interest than the inflation is eating away. So it's kind of a negative situation, and that just kind of sucks until the economy gets a little bit better. You also need to look at taxes and whether or not taxes can reduce your earnings on your savings, because you pay taxes on this like any other income that's been earned. And finally, you want to make sure that the liquidity of where you put your money fits your current needs. So liquidity allows you to withdraw your money on short notice without significant penalty. So you would not want to think, well, I might need this money to pay for an upcoming medical bill, or a baby that's on its way, or we're buying a house and we want to draw that money out in the next year, and you just sunk it into a CD that has a 5-year window on it, and if you withdraw it earlier than that time period, then you're going to have to pay fees. So make sure that how often you're able to take money out of a savings account or other vehicles that you would choose would match your liquidity needs. And finally, the slide that I keep referring to, you need to understand how your funds are protected if the financial institution that has your money fails. And that's where your FDIC comes in. This is the safety aspect of evaluating your savings plan, and FDIC is usually on banks, and the NCUA is on credit union associations. So most savings plans at banks and savings and loan associations, and then credit unions through the NCUA, are insured by agencies affiliated with the federal government. The FDIC, Federal Deposit Insurance Corporation. Coverage prevents a loss of money if that institution where you have your money fails. And the credit union does that through the NCUA. There are dollar amount limitations on what is insured. So for FDIC, it's $250,000 per person. Now, I don't know where you are in your life, and that may seem like a lot of money, but at some point as you're moving toward your retirement goals and you're getting closer to your retirement year, it may be that you have more than that much money tied up in a financial institution where they've invested those dollars for you. And if that's the case, in order to be insured, you need to have more than one person's name on that, or you need to put money through different financial institutions so that you are insured for the full amount that you have on deposit with that bank. So it's $250,000 per person per financial institution. So if you are married and your spouse, you could have $500,000 and still be insured through the FDIC or the NCUA. Considering, that it has happened in our past, it hasn't happened recently, but that's a lot of money, and I would certainly personally want to consider know that my money is safe and is being insured. I know we're getting long in this lecture. Just a lot of really good information here that I wanted to make sure that I brought forth so that you had. But let's look at our final learning objective, and I'll try to keep up the pace as we go through this last lap here. So learning objective number 4, comparing payment methods. In this chart in your book on page 124, and we're going to begin by looking at electronic payments. So transactions not involving cash, checks, or credit card have expanded with the use of technology, which we started our first objective talking a little bit about. We have improved security online and increased consumer acceptance of doing payments electronically. So some of the different types of electronic payments, we've talked already about debit cards and credit cards, and most retail stores, restaurants, and other businesses accept the check cards, Visa and MasterCard, and the debit cards. You can use your debit card with a signature like a credit card, or you can have a PIN number, personal identification number, like at an ATM machine that's attached to your debit card. You can use online payments to transfer money to other parties. Using these services, just be sure that you know what your monthly charge is, if there is one, and what the online security is, and what are their customer service availabilities, when are they able to assist you. If you have questions, when can you get help with those? And then there are mobile transfers. So you have lots of apps for mobile payment systems through your smartphones or tablets, or wireless devices, and these are always expanding. While these mobile transactions usually occur through a bank account, in the future these payments may actually bypass the banks with charges directly to your phone bill, and then they'll just appear on your phone bill. And then mobile banking is also increasing the availability of person-to-person payments, where you're actually able to transfer funds by email or by a mobile phone number to another person who would receive your payment, which is kind of cool. Stored value cards or prepaid cards, we've touched on those already, but they're prepaid cards for lots of different things in what we talked about earlier, like Walmart and those types of things, but we also have telephone cards, highway toll cards, laundry services, school lunches. I know my husband has a prepaid card where he works in his cafeteria. Some of these cards are disposable, and others you just keep reloading them, and a lot of times you get a discount for using them. And then finally there's the smart card. So that's considered like an electronic wallet that's similar to other ATM cards. However, they've got an embedded microchip that stores prepaid amounts, as well as information about your account, transaction records, insurance information, and medical history. So that's kind of neat too. I realize we're kind of getting long in this lecture, and we've covered a lot of this already. So other payment methods, of course, checking accounts, we've talked about that. Make sure you know if there's minimum balances due. You have to keep a certain amount in there. Sometimes they do that, or they give you monthly service fees, or there might be service fees anyway. An activity account actually charges for each check that's written and sometimes for each deposit made. So make sure that you know what kind of checking account that you have, a regular checking account or an activity account or an interest earning, or such as what's available to credit union would be a shared draft account. And a lot of times those require minimum balances as well. I think we've already hit on everything on this slide except for overdraft protection. So let me just take a second and touch on that. An overdraft protection is whenever the financial institution that you have the checking privileges with or debit card, instead of like putting you in overdraft or like refusing to cash the check and returning it, which then you have fees on the check that was returned, you can have overdraft protection where the bank actually does like an automatic loan to cover the amount of the check that has come in. But be careful about those as well, because oftentimes those loans that they use to put into your checking account so that you don't overdraft have fees with them. So you need to know if you have overdraft protection, which I think is a great thing to have, but make sure that you know what you're paying for that. One final slide, and then I think we will conclude our lecture. A couple of other payment types I want to make sure that you're familiar with. We have the certified check, which is a personal check with a guaranteed payment, and you have to get that from a bank or banking institution, credit union. Same with the cashier's check, which is a check on the financial institution. So you pay the base amount plus a fee, and then sometimes places that you do business with require a cashier's check. There's the money order, which you purchase at the financial institution, and post offices also sell those. Sometimes stores sell those, and it's a payment device purchased from the financial institution. It works a lot like a cashier's check. And then traveler's checks you hardly ever see anymore, but these allow you to make payments when you're away from home by using a traveler's check. You sign it twice, you buy it in a pre-set amount, like $20, $100, and then you can just use it like cash and get actual American currency back whenever you spend that. But I know the last couple of times my husband and I have traveled widely, we've looked at traveler's checks, and they're just almost a thing of the past, but the book does talk about them, so I wanted to mention those in case you've never heard of those. So in conclusion, I hope that you have found this to be a lot of really valuable information to your day-to-day financial planning. Just remember that the full deck of PowerPoint slides has been posted for you to review and use as study notes, and that there's also supplemental videos that I hope you'll take a second and just gander at. Those are well done and good information for you to have. So till next week, thanks so much.